Trav, let's get into it, mate. Sayona, you've gone in the weeds here, mate.
Matty.
What is going on now? They are raising $200 million.
They are.
But very close to production.
Mate, they are indeed. So it's a really interesting one. I feel a bit intrigued by it. I gave them a bit of a rap the last time we talked about them because, you know, it was a good story. Production was near. It looked like they were funded and cash flow was going to come in. And now they're out in the market today raising $200 million in a 2-tranche placement with Petra Capital, as initially reported by the AFR. So I think this one probably caught a few investors by surprise, but some of them were pretty clued on that it was going to happen. And it comes after Sayona. And keep in mind, their flagship project is the North American Lithium Project. This is in Quebec. It was a restart project. They acquired it in 2021, rapidly tried to restart it. It was, previously in care and maintenance. They brought it in a distressed situation and, raised money and funded it via equity and have tried to sort of get the wheels moving there again amid a favourable lithium price environment. So in all of the messaging that had been going out to market, it was looking like this company had already produced first concentrate. They came out with that announcement and they were flagging that first sales were going to be in July. So that's not too far away, right? July's only a month away. So the AFR, they first reported that Sayona were undertaking a capital raise. And it was really interesting how it was reported by the AFR. They had in there that a price at 15 cents per share for a period of time, and then they deleted it from the article. And when the term sheets actually went around, what we saw was that the actual raise price was 18 cents per share.
Okay, so the term sheet is around now because I know it wasn't early this morning.
Yep. Yeah, it is. And
we're just letting everyone know we've got access to term sheets because we're kind of a big deal these days.
You don't ask, you don't get, Matty.
And then this is on top of because they're dual listed, they already raised $50 million in Canada in March as well. So now this is another 200 on top of that, in line with the fact they've already produced first concentrate, but they haven't sold the first concentrate yet, have they?
Exactly right. So in that $50 million that they raised in March, probably gave a false level of certainty in some ways to the market that they would have enough cash buffer to see them through to that cash flow from their production. And the reason is because the way that financing deal was struck, it was a flow-through placement to Canadian investors, and this is basically lets you conduct this equity issuance at a premium because the Canadian investors benefit from some sort of tax benefit associated with it because the money is supposed to be spent on exploration. So when you think about what Sayona can actually do with it, they have to use that cash for exploration purposes. So therefore, if they're having some kind of working capital issue in relation to the ramp up of their operations, that money can't exactly help them out in that situation.
And is that just held in a little separate bank account? How the hell would you monitor that?
I'm not sure. Maybe there's probably some rules around it, but
that's it.
Yeah,
it's very interesting.
They're probably accounting rules rather than physical custodianship rules. But
they've definitely had a significant rise from 1 cent back in the day to what they are now during this lithium boom. Big valuation.
They've got a big retail following behind them as well. But interestingly, they don't have a huge amount of sort of institutional investor research coverage. It's a limited set of players there, and most of those players, they partnered with them on their various sort of equity pursuits along the way. So despite strong interest from a retail market, limited interest from that institutional market in some respects, but we'll get to that. So, mate, I saw this announcement, right? $200 million. Oof, it feels like a lot, right? And keep in mind the company's nearly capped at $2 billion, but $200 million when you've got cash flow around the corner feels like a really chunky raise. So, and you think, okay, $98 million cash at end of quarter, like what's going on here? Why do they need $200 million, right? Because you want to minimize your dilution to existing shareholders. So I think let's unpack all of these points, one by one. And we mentioned that $55 million raise involved some degree of restricted cash. So, which actually resulted in them cutting things pretty tight if you extrapolate their burn rate from their last quarter, you can actually see $36 million in cash went to OPEX, $28 million to CapEx in the March quarter alone. So that's $64 million out the door that quarter. And you can kind of just extrapolate that out and see that there would have been a bit of a funding gap during ramp up, and a lot of pundits were anticipating that. And I think that partially explains why the company was the 6th most shorted stock on the ASX yesterday, with 8.4% shares shorted.
Wow. And they're because if you look at the chart, they're on that right at that bottom of that Lassonde curve. I know there's some big spikes in there, but they were up at 30. Now they're just on there. So they're close to first commercial sales. They're back. They were closed at 21. Now they're raising at 18. So it's like they're at that point that I guess you like to take interest in, Trav. Is like where from at this point, is it going to be a continual downward trend, or are they going to bounce back up to this start reaping the benefits?
This period is really make or break for companies, because what happens is you have so much ramp up risk. A lot of stuff can go wrong when you're ramping up a mine, especially one with complicated processing. There's so many examples of ramp up issues, and how do you solve ramp up issues? Especially like in this case, they don't have debt, but whenever you have debt as well involved in the financing of the project, then your ramp up issues get resolved by diluting the heck out of your existing shareholders and hoping you can figure it out on the fly before your repayments kick in. Otherwise, you end up issuing even more equity to service that debt in the process, and your share price just looks horrible. So it's a really interesting time for companies on that Lassonde curve, Matty. One that I am very interested in.
Did they any info on who is participating in the 200 mil, or too early yet?
I can't get any info on that yet. But the way I think about it is if you had 8.4% of your shares shorted, 8.4% of just round it up to $2 billion is nearly 200 million, right? It's not too far away. So think of everyone short. Not everyone short would close their short, but anyone who was short, and there was a lot of people that were short, right? They can effectively close out their short position by buying shares in the placement at that 15% discount, and there's 15% risk-free money right there.
And we've talked about that. That's the fundy tactic, isn't it? It's seeing if there is a potential funding gap for these companies.
Yep.
Hold a short position.
Yep.
Then ride it on the way down and close your short, participate in the raise.
100%. So
it's a double banger.
Yeah.
I mean, considering when Liontown had that big short squeeze, I think from memory they were about 9% shorted.
Yeah.
But it obviously went the other way for them. They thought they had a funding gap, but then they got a takeover offer.
Yeah, and it's not always a it's not, I called it a risk-free return, but the reality is you don't know when they're going to pull the trigger on a raise, so you're accepting some share price movement risk in the interim period of time too. But I mean, it begs the question, I think, to me about the timing of this capital raise, because you look at the public materials that Sayona put out, and I kind of think that they had a few options up their sleeve in order to kind of have a strategy around doing an equity raise that may have been at an even more favourable share price if they wanted to go down that path. And I think it's interesting the route that they've chosen. And what I mean by that, if you look at their quarterly that came out, they talk about expecting a PFS expected to be out in May. So there's not too many days left in May, and there are some reports that kind of it's in a review period at the moment. So maybe they're sitting on it, maybe they're reviewing it. But it's an interesting strategy not to wait for the release of that and then launch an equity raise off the back of that, if that was going to be a positive share price catalyst and you could have less dilution. So I found that interesting. And the other thing I think it begs the question around, right? They've already produced first concentrate, and they've clearly got line of sight to first sales in July. They talk about. So if you've got line of sight on first sales and you've already got the product there, the other strategy you could have done is announce a prepay agreement. So in this case, we know that Piedmont are getting a portion of those sales, but the other sales are sort of subject to another agreement. And they could have announced a prepay where they get the cash in now to help them bridge some degree of working capital issue while ramp up's kind of going on, and that just results in less dilution if you can get that cash in early. And even in addition to that possible prepay to help bridge sort of some working capital issue, another strategy they could have done is actually just announce the terms of what pricing they're going to receive on that product. So, they haven't announced that yet, and maybe they could have waited to announce something like that, and that could have been another positive catalyst if the price that they're receiving on their product was greater than market expectations. So I think there's just some question marks around the strategy here, and I think even that prepayment point was one that Canaccord themselves, noted in their latest research note where they say, Sayona retains some funding optionality, including prepayments on its share of productions. Should there be some funding challenges there, and so they haven't gone down that path. They've actually just gone for the more dilutive path to existing shareholders and raised $200 million.
Well, it depends where you're sitting as an existing shareholder, doesn't it, Trav? If you're a retail shareholder and don't get to participate, you're getting fisted. But if you're one of the major shareholders, you're getting great bang for buck to raise at this 18 cents. So
you'd still be peeved though. Even if you're an existing shareholder, right? Sure, you get to follow your rights, but I'd prefer that the company did a prepayment so that I don't have to tip in more money and my ownership stays the same.
Depends on your long-term outlook for it. If you've got a long-term view of holding and getting bang for buck, but
it's a different risk profile. But your return on a per share basis, you have a better equity IRR if they had some sort of non-dilutive pseudo debt instrument via prepay.
I suppose it depends if they subscribe for their shareholding, they don't get their future returns don't get diluted, but if they're every bit they subscribe for under what their current shareholding is, they're getting fisted.
Yeah, and they've got to tip in more themselves. Like if they want to keep their same pro rata ownership of the company, and I'd rather, not having to tip in the pocket, especially when funding cash balances are probably not as what they used to be. They're kind of being a bit more conservative on cash, and retail is as well. So
I suppose for people listening that don't fully understand, because we do focus a lot on, I guess, dilution and how that is a negative. And I guess the way to understand it, if you're from a non-financing background, is every extra share that's issued means it's diluting the future. Like the future returns are not probably going to change. Like the assets aren't changing. The output is not going to change. It's the cash dilutes your shareholding, so your share of those future returns of the company are going to be less. So that's why dilution for all the retail people is
totally
is a bad thing.
You only own a certain percentage of that company, and the more shares there are, the less that percentage you own.
Well, because unfortunately, not everyone bought this share at 2 cents. So they're raising at 18. There's would have been a lot of people bought it at 30 cents during this lithium thing. So now it's gone down close to 50%.
Yeah,
gone down 40% and getting diluted. So
and it's built a bit of a cult following in the process. When people make a lot of money in something, there's there are some churches that form around things. I think finally, Matty, it's pretty important to remember the history of this asset. So North American Lithium, it used to be called the Quebec Lithium Project. It was developed by a company called Canada Lithium in 2013. In that same year, that company faced a class action lawsuit for providing some misleading information in an October 2010 resource statement regarding the volume of ore and grade of the lithium project. They had to raise a bit of equity as the ramp up. It wasn't as smooth, and they even did like a prepayment deal themselves to try and get them through a rocky period and bridge that working capital hurdle. So this Canada Lithium, while they announced achievement of continuous production in November 2013, they ended up merging with Sirocco Mining the next month and retained about a 58% ownership of the pro forma. They renamed RB Energy. So with this new name, RB Energy, and a few more equity raisings over the following year, RB Energy put it on care and maintenance in October 2014 and entered receivership in May 2015. As a private Chinese company, Jilin Nickel Industry Company acquired that asset out of receivership in 2016. And obviously, private hands, you couldn't see too much about it. But you couldn't see too much until Sayona and Piedmont acquired it from them in what appeared to be a pretty distressed situation. In that kind of deal, what you saw have to happen was Sayona agreed to pay down $50 million in Canadian dollars of the debt of that entity and assume another, Canadian $36 million of debt for the acquisition. So you can see,
very troubled.
Yeah,
history
taking on their
here.
debt and paying down their debt. It's a distressed situation, right?
That's an interesting one about the statement regarding the volume of ore and grade for the lithium.
Yeah. So maybe it was developed under some questionable circumstances. But and don't get me wrong, Matty, the lithium market is completely different now, and I understand that, right? But we the history of trouble ramping up this operation is something I'd still be nervous about, right? Especially if you're raising $200 million. I just want to know as much information as possible if I was a shareholder, the bare minimum being how much do you need to get through this ramp up period?
And it'd be interesting to watch, and this is also going to validate how this project goes. I know this is not the only lithium project in Canada, but there is, a lot of exploration and big ones potentially coming in the future. So seeing this work successfully is going to be a big factor for a lot of other companies trying to develop these projects in Canada.
Yeah, so. And don't get me wrong, right? I might end up eating my words because the term sheet could have been accompanied with an investor presentation that had super detailed, progress report about ramp up at this point in time. But but I think if you were, I think you've just got to sort of talk about how much money is needed for this interim period until cash flow comes in. So,
well, I'm sure the brokers and all the buy side that are looking to participate in this raising and be asking the same question, wouldn't they? What are the funds being used for?
Well, it depends who's your typical investor in this, Matty. If you get most of that book away from short, the hedge funds or whatever who are closing their shorts, they don't care about the future of the company. Yeah. That's them, exiting their position. So, and then retail, do retail get privy to management to ask those questions? I'm not sure.
Yeah, very interesting, right? A bit more to play out. So I like travelling on this part of the Lassonde curve because this is when all the big news is to see if they're going to convert or not.
Mm-hmm.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation and needs.